Guys, I want to share with you my top 9 strategies. 9, not like 2 or 3, which is great. 2 or 3 is great. It's better than 1, isn't it? Right? Not my top 3, not my top 5, my top 9 strategies for getting short-term rentals, STRs, vacation rentals, regardless of your credit or how much money you have. Hello and welcome to the Creative Cash Flow Show. I'm your host, Jesse Mills, where each week I will bring you real estate secrets for achieving time and money freedom. And one of the ways that you can achieve freedom faster and frankly with more fun is by having vacation rentals. That's right, having an Airbnb, having a short-term rental, having an STR, right? These are all the different names people call it. Airbnb is so generic, right? It's just one company. But guys, having vacation rentals is a fantastic way to get lifestyle and financial freedom. You get both. I taught an event last year, and we actually have another one on the schedule coming up. So if you're interested, keep listening and even reach out and I'll get you the details. But we have another one coming up. And guys, at the event, what we talk about is there's a pendulum, okay? There's like this pendulum. And on one side of the pendulum is folks who are like, hey, I just want a second home. I want, what most people call a cabin, right? In Minnesota, for example, everyone's got a cabin. It seems like everyone's got a cabin, right? If you don't have a cabin, your neighbor does, your relatives do, your friends do. But you have a cabin, and that cabin, right, or second home just sits there empty, making no money at all when it's not being used. And some people want that. That's all good. I'm not saying there's anything wrong with that, okay? But on the flip side, right, that's all the way to one end where you're making no money when it sits there vacant whenever you're not using it. On the other side of the pendulum is something that's purely an investment product, okay? It is purely, you're only purchasing it because it's going to make money. It is going to hopefully appreciate in value. It's going to, create equity. It's going to be paid off. Your debt is going to be paid off or paid down by other people. Your goal is to get cash flow, right? Every month. You should be making some money on that. That is the goal on the other side of the pendulum, okay? Now, here's the cool thing is there's no right or wrong where you fit on the pendulum. It really depends what your goals are. And sometimes you might want, one set of goals for a certain area, okay? So for example, maybe you love to ski and you're like, yeah, if I could have a place out in, Vail, Colorado or Park City, Utah, right? Or Big Sky, Montana, and I could go there and at least if it's kind of covering part of the costs, that's fantastic, right? I just don't want to be paying on this whole thing every single month, right? And every year, all out of my own pocket, right? I just wanted to cover part of it. On another side, you're like, hey, I don't have the money for that. And that's not my goal. I'm looking to just make as much money as I can. And I don't care if I ever go to the property. This thing could be in the middle of a field in Kansas. If it's making money, Jesse, if you say this thing has got great cash flow potential, right? Great ROI, great cash on cash. It could be in Delaware. It could be in Kansas. No offense if you live in Delaware or Kansas. I ain't saying nothing bad about it, right? But maybe it's an area that you just don't perceive as something you want to go to all the time, okay? So keep that in mind, guys, when we talk about this, because when you go look to acquire more properties, all right? You go to look to acquire more properties, you're going to have different opportunities, especially when you're looking for them, right? Because they don't always just present themselves. A lot of these opportunities you have to find, you have to create. You might have to talk to 50 or 100 different sellers or agents to see if this is a fit, okay? So when that, when you're looking at a specific market, you got to keep that in mind, all right? So guys, I want to share with you my top 9 strategies. 9, not like 2 or 3, which is great. 2 or 3 is great. It's better than 1, isn't it? Right? Not my top 3, not my top 5, my top 9 strategies for getting short-term rentals, STRs, vacation rentals, regardless of your credit or how much money you have. That's right. So you might have okay credit. You might have bad credit. You might have real ugly credit. This can still work, guys. This can still work for you. So listen up. You might be in a situation right now where you don't have a lot of capital, right? maybe you're just it's the time of your life, or it's just the season that you're in, or something's going on. You just don't have a lot of money. That's okay. There's still a way to get vacation rentals, cash flowing, money making vacation rentals without having a lot of money down and without having great credit. Now, if you have a bunch of money, but crappy credit, you're definitely a step ahead. And if you got great credit, but not a lot of money, you're a step ahead. And if you got money and credit, well, hey, you're definitely in a great position. Okay. But even if you've got good credit and you've got money down, still listen up, because you have even more options available to you than the one or maybe two or maybe three that you think you've got, right? You've got a lot. Okay. So let's talk about the 9 different ways you can acquire short-term rentals. All right. Starting with number 1, seller financing or a lease option. Now, oftentimes, guys, people put seller financing and lease option in the same bucket, right? They kind of call it the same thing. And for all intents and purposes, it's very, very similar. But with seller financing, right, the seller is playing the bank. They are giving you an interest rate, right? They are lending you the money and you're paying them every month like the bank. Okay. Now, a lease option is a little different because you are renting the property and you have the option to purchase it. Okay. Both of these I love though. Why? Because the purchase price is whatever we negotiate, right? How much money do I put down up front as the buyer is whatever we negotiate. Of course, they want to have as much money down as possible. I want to have as little money down as possible, right? So it's whatever we negotiate. What is the monthly payment or what is the interest rate? It's whatever we negotiate. How long is the term? It's whatever we negotiate. So some people, I just had a call with a woman the other day and she was willing to give me 7 years for sure, maybe 10 years before I would have to go pay her off in full. Now you might say, well, Jesse, you're going to pay her off, and then buy the entire house in 7 years? Well, no, probably not. I mean, if I can, fantastic, but probably not. I'm going to go get a new mortgage and pay her off when I need to. But 7 to 10 years later, holy cow, that's fantastic. That gives me a ton of time for the value to go up, for the debt to go down, right? For me to improve the property, for me to have cash flow, for me to make more money and save more money. It's great. Okay. So seller financing and lease option, guys, are my favorite strategies to get into a property. Now, next, number 2 would be sub 2 or subject to, guys. And this is kind of slang for subject to existing financing. Okay. So subject to existing financing means, let's say the seller has a 4% interest rate and I'm going to go in and basically take over their mortgage and I'm going to pay their mortgage for them every single month. They're going to deed me the property. I'm actually going to get the property. Okay. So they no longer own it. They have deeded it to me. I own the property. They still have the financing in their name and I am responsible for paying their loan for them. Okay. Now on the first one with seller financing, and let's get even a little bit more specific, like contract for deed or a land contract, right? I like those because basically my deal is directly with the seller. I have equitable title, okay, in that example, and they still completely hold the title a little bit until I get it. I think this is just a little bit more fair. I think this is a better way of doing business. It also doesn't hurt them as much when they want to try to go get financing in something new, okay? So that's my personal opinion. You might want to do it the other way. But number 1, seller financing or lease option. Number 2, subject to, okay? Number 3, STR pod. So what's an STR pod? Sounds like something you got at the hospital, right? A short-term rental pod is one of the fun things I like to do is create these pods of anywhere from 2 to 4 people. And essentially it's a brand new partnership. And the cool thing with this partnership is we are bringing different people to the table that all want a common goal, which is a cash flowing vacation rental. But one person might be that really busy entrepreneur, that's super busy professional who has no time. They've never, managed a short-term rental in their life, nor do they really want to. Okay. But they've got capital or they've got credit. So they can go get financing, no problem. And they've got the down payment, no problem. But they just don't have the time to do it. They don't have the experience, right? So on the flip side, we've got someone else who's like, hey, I've got 5 of these. I know what I'm doing. I'm very experienced and I've got the time and the energy and the resources. But right now, I just don't have all the capital to do another deal. Or perhaps I can't get the financing myself, right? So you've got that person on one side, you get the other guy on the other side, okay? So if you take those two people, right, they completely have a great yin and yang for helping each other get a vacation property. Now, I will say with this, it's definitely smart to have a list of questions, and this is something that I can help you guys with as well, but list of questions that you go through up front to make sure everyone's on the same page. For example, let's say you've got three couples that all have kids in, grade school. Okay, three couples, and they all love Florida, and they all want to go to Disney World in Orlando, and they love that area, but they all have the same spring break. Well, if one couple is just assuming they get it every spring break, right? Because maybe they found it, and the other couple's like, well, yeah, but we're financing it, and they assume they get it over spring break. That's a problem, right? So you just got to hash that out. The other thing is, let's say you've got somebody who says, hey, I really am all about just getting extra money right now. I need, as much income as I can get. So if this thing is, spitting off $2,000 a month in cash flow, right? Maybe over the year, that's the annual, or that's the average, right? Over the year is 2,000 a month, right? Because things go up and down. And I want a piece of that $2,000 a month. I want it every month. I want to start getting paid on this property. And then you've got another person saying, well, that's fine. I don't need to get paid, but I think we should dump it back in the property. Again, I think we should put it back in. So we have at least, 3-4 months worth of payments set aside. We've got a reserve contingency in case the taxes go way up, in case there's damages or repairs, right? And some other person saying, hey, I need to get paid on this right away. Okay. So we could do a whole episode, guys, just on partnerships and going in and purchasing properties and kind of all the things to look for and to think about and to ask and to, get down in an operating agreement. But what I will say is it's a great way to do things. I have done it. It's been very fun. It's been very successful. And, together we're looking for more places. Okay. So that's the STR short-term rental pod. I like to say that's number 3. Okay. Now, number 4 is the BRRR method. BRRR, right? Some of you are like, oh, BRRR. I know what BRRR is. And I don't mean chili in Minnesota. Ha 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 ha. Dad joke, right? BRRR is buy, renovate, rent, refinance. Okay. So this is a fantastic way that a lot of folks who are newer investors or are learning and listening and reading and watching and trying to get in the game, this is how people get in. So they get a property that is way below market value. Okay, it needs work. The property needs some work. That's why you're getting it at a deal at a discount, is because she's a little ugly. She needs some work. She needs to be updated. She needs some repairs. Okay, so you go into it knowing that you're getting it at a discount. You know that you're going to put money into the property, fix it up. Then what you're going to do is you're going to, once it's all fixed up and ready to go, you're going to get a renter for it, or, either a long-term renter is kind of the normal BRRRR method, or you're going to say, this is ready for short-term rental now, right? So this is ready for our guests. And you know what it's going to be making. It's going to be making a lot more money because you've gone in, forced the appreciation. You've added value to the property. You've made it nice, right? And you did that with your own, sweat equity and real capital, okay? So at that point, now you can go to the banks and say, hey, banks, check this out. Look what we did, right? Now that property is worth a lot more money, and we can command a lot more per month or per night or per week, whatever, however you're renting it, short-term, long-term, midterm, okay? And they're going to say, okay, cool. Well, here's what we think the value is now, and here's what you owe, which of course is less. And then you can pay off whatever source of money you used to get the property. If you use your own cash, great, pay yourself back. If you used hard money from a hard money lender, you can pay it off that hard money lender and get a much better deal. Okay. If you have, private financing, private money, maybe they want to get paid off, quicker, so you can pay them off quicker. Okay. So it all depends on how you acquired it. But the BRRRR method is a great way to do it. Now, why is this not one of my first methods? Because it's still, work intensive. Okay. So if I'm looking at places all over the country, which I am, right, I don't necessarily have contractors that are right in my Rolodex in, this state or this state or this state. Okay. I really got to rely on other people heavily and, what they say and what they know. It's harder to keep your eyes on the project. Okay. So that's one of those things where you may want to actually, again, kind of do a combination of this, guys. Do the STR pod and the BRRRR method together. So you could have a dude that's like in Arizona, who lives in Arizona, who says, oh yeah, these are rehabbers and contractors I know. These are people that I can go check on and, I can vouch for them. And maybe that's part of your partnership, is them managing it, right? And then you are helping find it, or you're going to help manage the property once you get it going. Okay. or you're going to help with the capital because you got that, or you got the financing, right? So all of those different ways that you can bring it together. Okay, so that's number 4, the BRRR method, BRRR, BRRR. Number 5 is arbitrage. Okay, arbitrage, Airbnb arbitrage. Ho, ho, ho. Man, this has been one of the hot buzzwords for the last few years here. Okay, so what short-term rental arbitrage is essentially, let's say you pop on Zillow, okay, and you go look at places for rent, and you see a place for rent and it's $2,000 a month. And you're like, wow, I know that property in that neighborhood or that city or that market could make, $4,000 per month easily if it was a short-term rental. So what I'm going to do is I'm going to go talk to the landlord, and I'm going to do a 1-year lease, 2-year lease, maybe 3-year lease, right? And I'm going to say, hey, I'll give you your $2,000 a month, and sign me up. Let's roll. Okay. Then you go put it on Airbnb, or you put it on Vrbo or Booking.com or wherever you put it on, whatever platforms, right? And then you start using it as a short-term rental. Now, why is this awesome? Well, did you go buy this house with 20% down? No. Did you come in with 10% down? No. You probably came in with 1 month's rent, maybe 2 months rent. Okay. Now, this is definitely something though that again, we could do a whole episode on this. Any one of these strategies, frankly, heck, any one of these strategies we can do an entire episode on. But with this, right, does your landlord, because you're a tenant now, right? You signed a lease with a landlord. You don't own the property. Okay. Keep that in mind. Do they know that you're going to sublease this out as a short-term rental, right? Because you're the tenant. Now, do they know that? Now, some people don't tell the landlord. I don't think that's cool. I think that you should always be above board. You should always be telling people exactly what's going on. Explain it to them, educate them, right? Tell them how it's a win-win-win. But some people don't, okay? And that's a risk you take. Now, imagine if you're there for, 12 months, and you just assume you can keep on rolling because everything is going great. And it's, month 13 or 14. Now you're on a 1 month or a month-to-month lease, and you've got $20,000, $30,000 worth of furniture you put in there. Oh yeah, that's right. Because you had to furnish it. You had to set it up right for your Airbnb. And now they're like, hey, I'm selling. You got to get out, right? And you got bookings and you got this and that. Now, this is one way it could go. It could go a lot of different ways. Good, bad, all of it. But what I'm saying is I like to have control. So I like to, again, I'm telling you in the easiest ways, kind of from 1 to 9, the easiest ways with little money down or faster ways of doing it. But I like control. Okay. So whole different set of, pros and cons we can go into there with arbitrage. That's number 5. All right. Now, number 6, if you do have good credit and you do have some money to put down, you could do a 10% down second home mortgage. Okay. Now, why do I like this? Well, I would all day long rather do 10% down on a second home mortgage than 20% down on an investment property mortgage, because it's 10% down, which means I've got more money to go do more properties and keep growing my cash flow faster and have more properties and more areas, right? Why would I want to just go to 1 when I could go to 2 or 3? Okay. So 10% down, conventional second home. It's a second home. Okay. So here's something that I run into a lot. And then frankly, I've had, pretty smart, intelligent agents and investors who even think this. Okay. So I think this is worth mentioning. You can have more than 1 second home, guys. Okay. You don't just get 1 second home. There's no rule that says that. Now, you can't have 2 second homes within a block of each other. Okay. The bank's gonna be like, wait a minute, you have a second home and then a block away you have another second home? That doesn't make any sense. Okay. So that's not going to fly. That basically looks like mortgage fraud, and it probably is because you don't have 2 second homes. But does it make sense that you would have, a cabin in northern Minnesota and you would have a beach home in Florida? Of course it does. Those are 2 totally different areas, right? Does it make sense that you would have a beach home in Florida and a place in the mountains? Of course it does, right? So you can have multiple second homes, but you just definitely can't have them right next to each other because you're probably not using them both as a second home. Now, a second home mortgage, guys, okay, one of the big caveats with this is it's a second home. It is not a rental property or investment property. What that means is you are not going to be getting any rental income on it. Okay, now maybe that once you acquire that property, when you're not there with your family enjoying your second home, you might want to get some income in there. So you might throw it on Airbnb or VRBO or whatnot and try to get some money at your second home to help cover the expenses. Okay, that's fine. But that's not going to help you qualify for the mortgage, because when you're telling the bank I'm getting a second home, that's a second home. So if it sits empty for a year because you never go use the damn thing, they have to make sure you can afford that second mortgage. Okay. So that's the thing, guys. It's 10% down instead of 20, but you got to qualify. You cannot count any income coming in whatsoever. All right. Now, the next best option, if you're like, well, okay, this property I want is a $4,000 a month mortgage. I can't have another $4,000 bill without having more income coming in to offset that, right? So if that's the case, now you're looking at a non-owner occupied property, AKA an investment property. And there are options, guys, with 15% down. Most people don't know about it. Most people don't talk about it. Rates might be higher. The fees might be higher, but sometimes you can get a 15% down non-owner occupied investment property. Okay. So 15% down. Again, I want to put down as little as possible because I want to spread my capital as far as I can into multiple properties, multiple markets, right? And diversify it that way. Okay. So number 7 is a 15% down conventional investment property. Okay. Now, number 8 would be a 20% down conventional investment property or non-owner occupied loan. Okay. This is kind of the cookie cutter stuff that everybody does when they want to go get an investment property, right? Most people, by the way, guys, especially if you're not listening to a show like this and you're not surrounding yourself with people who are doing creative real estate strategies, and you're listening to people who are not investing or people who don't have the experience, right? They're starting here. They're starting with one of the worst strategies, in my opinion. Okay. They're starting immediately with 20% down, dealing with the banks, dealing with all the crap they make you go through. All right. It's 20% down. That's your option. And if you don't have good credit, you're not going to get this. And if you don't have 20% down, you're not going to get this. Now, again, you're like, well, hold on, Jesse. What if I go back to number 3, where you talk about the STR pod? What if I can get the 20% down financing, but I want some capital from my friend over here who also wants to enjoy this place with me? Bingo, right? You could do that. Okay. So now you're seeing how we can put these strategies together. All right. So what's the last one? What's number 9? Well, number 9 could be number 1 in the sense of easiness. If you have the money, it's easy. But if you don't have the money, it's not easy. And frankly, the rates and the fees and the points and whatnot are kind of garbage, but it's a strategy and it works. Okay. So number 9 is a 20% down, what we call a stated investment property loan, or a DSCR. Okay. DSCR, what the heck does that mean? Well, that stands for debt service coverage ratio. Debt service coverage ratio basically means, guys, this is almost back like 2008 days where you don't have to prove your income. Okay, so let's say you're an entrepreneur, you make $250,000 a year, right? But you write off like $230,000 of it, right? And all your expenses and this and that. So really you make 20 grand at the end of the year. Ain't no bank going to give you a $500,000 mortgage to go get a vacation property when you make $20,000 a year. It ain't going to happen. Okay. So you're going to say, well, hey, I really kind of make more. I just have a lot of write-offs, blah, blah, blah. The banks, they don't play that way. Okay. So if you go do a DSCR loan, like I've got the 20% down, they're going to say, okay, does this property, does the asset that we're basically using as collateral, will it pay for itself? Well, if it will pay for itself and there's enough rent coming in every month, whether it's a long-term rental or a short-term rental, and it will cover the payments, right? There's a ratio that you have to hit. Typically it's 1.1, maybe 1.2 of what you're paying, right? So what you're paying has to be a little bit less than what you're making, right? It can't be losing money. It's going to be making some money. If it is, they'll say, cool, we'll do this deal. But here's the thing, guys, you still have to have, definitely, I would say above average to good credit to get this. And you got to show that you've got the 20%. Okay. And the fees can be kind of substantial. The fees add up, also known as points. Okay. Then oftentimes they have a prepay. So if you want to refinance this and get rid of your crappy 9% or 8% or 10% interest rate to get something better, you're going to pay a really big prepayment penalty. Okay. So again, you could look at this from 2 different angles. Say, Jesse, holy crap. Yeah, I'm a business owner. I write off everything, right? Or I'm in between companies, or, I've got 3 part-time jobs, 4 part-time jobs. Every other bank is saying no, no, no. Okay, well, this is a great option that you could look at then, but you got to have the credit scores, you got to have the money down. Okay, so it's easy, but it's also not the best thing if you can get any of these other ways. All right, so real quick, guys, we're going to recap this. Best ways to get a short-term rental regardless of money down or credit. Top 9 ways. Number 1, seller financing or a lease option. Number 2, a sub 2, subject to. Number 3, an STR pod, short-term rental pod, right? We're kind of combining money and time and yin and yangs with people's strengths, okay? Number 4, we're talking the BRRR method, BRRR, right? Number 5, arbitrage. Number 6, a 10% down conventional second home loan. Number 7, 15% down conventional investment property. Number 8, a 20% down conventional investment property loan. And number 9, a 20% down DSCR no qualifying / no proof of income loan. Guys, these are the ways to go about it. So if you're looking to get your first or your next vacation rental, okay, you got questions about it, hit me up. I love to chat about this. I love to help people get in the ball game. I love to help them get their first property, grow their empire, right? Be able to take their friends and their family and their kids, get the heck out of the cold winters and go somewhere nice and warm and enjoy it and make memories. And it's awesome. Like, I'll be at one of my properties and I have another one next door, and I'll just be watching these people outside grilling and laughing and having just a great time. I'm like, oh my God, I'm making money right now. And these people are on vacation, having a fantastic time, making memories, right? And I get to be a part of that. How cool is that? So this is definitely one of the strategies I love to chat about. So again, guys, thanks for joining me today. And if this helped you, would love to have a great comment from you. What part of this helped you the most? And questions, hit me up. You can find me pretty much on all the socials at the Jesse Mills, or of course my website at thejessemills.com. All right, guys, until I see you next, have a great rest of your day, have a great rest of your week, and we'll talk soon. Thanks so much.